Now, once you've completed your business plan, it's a good idea to think about whether your idea is financially viable in the long term. A financial plan can help you figure out if your business idea will pay the bills, make a profit, and then satisfy your financial goals. A financial plan will tell you if your idea will make money. It should also tell you what sort of investment is needed and when you will need to make that investment. Now, a good financial plan might include some, if not all, of the following points. Setup costs. Research and list all the items you need to start your business and work out what the upfront costs will be and then how much you'll need to borrow. Some of the obvious items and costs will include things like the lease of a premises, equipment, machinery, office equipment, and furniture. Registrations, company formation costs. Working capital. Now, working capital is the amount of money you will need to cover your expenses until your business is generating enough product to pay those expenses. Profit and loss forecast. Estimate your sales and expenses on a monthly, quarterly, or yearly basis and gauge whether you can expect to make a profit or loss for each of those periods. Now, this will help you develop sales targets, pricing, and likely profit margins. Cash flow forecast. A business that makes a profit can still run out of cash. If you make a lot of sales in, say, the first month, but only receive payment for these a month or two later, you might not have enough cash available to pay for your suppliers. So cash flow projections can help you recognize whether you'll have enough cash to run your business or whether you'll need additional funds to put into the company. You will also have to understand your break-even point and what that means in terms of monthly sales and revenue. Have you been realistic in your budgeting with both revenue and costs? If your cash flow shows you're not making any money or won't make any money for a while, do you have the reserves, the cash in the bank to get you through that time period to profit? Balance sheet forecast. Now, a balance sheet is a snapshot of the business on any given day. Now, this is a good way to evaluate if the business will be financially sound after a year. List all your expected assets and liabilities after your first 12 months. Now, you should include essentially three basic sections in the balance sheet. Assets, now that's what your business owns. Liabilities, what your business owes. Now, that might be on the assets, that might be for stock. Owner's equity, this is the portion of the assets that belong to the business. Now, calculate this as the total of your assets, then subtract your total liabilities. That's your equity. Break-even point. This shows you the number of sales needed to cover costs and can be useful for analysing the sales, costs, and pricing numbers used in your earlier forecasts and judging whether your business idea makes financial sense. Is break-even too far away? Should you revisit your cost and your markup structure? Yeah, I know. I've repeated this many times, but it's important that you get the right advice, especially when it comes to financial matters. I strongly suggest you talk to an accounting professional to help you get it right before you start out. Hey, thanks again for watching. If you like the video and would like to leave me a thumbs up, maybe a comment or ask a question down below, please do so. I read and reply to every comment. I try to answer every question, and I would love to hear from you. If you want to know more about starting a business and want more tips on successfully improving your business, hit that subscribe button. Until next time, see you again. Well, hey, like it.